All right, everybody, what's going on? What's up? Kind of a quiet day, but that's not much of a surprise, because that's what the plan was when I did the morning briefing. Kind of the plan for the week, at least the first part of it. So at least it's on schedule. It's doing what it's supposed to do. I guess we can, you know, find a little comfort in that. Hey, what's up with you? Part of it. So at least it's on schedule. Yeah. I do that with my Think or Swim as well. It fills up with a bunch of stuff, and you got to clean it out. That's why I built that Think or Swim Discord. Really, just I had so many studies and charts and watch lists and indicators. Sorry, I was answering a support question. We got these old videos that show that there's an options channel and a futures channel and a stock channel. So people show up and they're like, "Hey, where's my channels?" Sorry, we don't got those anymore. Everybody would hang out in one channel and miss everything that was going on in other channels, and then wouldn't go to the other channels, wouldn't participate, wouldn't chat, wouldn't post, wouldn't communicate. So why have all the channels? Of course, there's always some bloke out there who says, "Wow, there's just so many channels. Can't you guys get rid of all this stuff? It's so cluttered." You can't win for losing. Yeah, it's always somebody not happy. So last week we were talking about an options trade, a diagonal or a calendar. And while they're kind of the same thing, they have the same mechanics. The difference is whether or not you trade the same strikes on both of the options. So um, the the naming comes from the way that we build the trade. Verticals are called verticals because that is the direction that you move when you build the position. You are moving vertically within the options chain, either up and down or down to up, and so that creates a vertical presence. When it comes to a diagonal, you're moving diagonally through time, and then of course you're also, since you're not just going in a straight line from one contract to another contract along the same pricing, that would be a calendar. You're instead going up to a higher strike, or you're going down to a lower strike, and that becomes a diagonal. So that's where the names come from. So with that in mind, now that we know why it's called that, the way to build it is easy enough. You always sell the front contract, and it's really important to do that because the way the broker reads the trade is by the one that's going to expire first. And then they read the one that's going to expire last. The short trade has to expire first so that you're not left with a short call that can't be covered, right? So you always have to have the short first. That way, you always have coverage behind you in time. If you don't build it that way, if you try to buy a call in the front end and then sell a call in the back end, they're going to see it as an uncovered call, and that's not structured. That's not allowed on a lot of platforms. They're just going to kick the trade and say you can't do that. You need to have it covered in some way. So you always sell the front, buy the back, and because you're doing that, things closer in time, generally speaking, are less expensive than things farther away. So, if I sell something cheaper than I buy, there's a debit left over that isn't covered. And that's why the trade is generally opened for a debit. It doesn't have to be. Obviously, I could sell something deep in the money, which has a lot of credit to it. And then I could buy something farther out of the money, farther out in time. And that would, of course, generate a credit of some kind. So right now, if I sold that for 71.80 and I bought something worth 56, you can see it turned green like a debit, but there is a minus sign in there, and the trade would be opened for a credit. So, you can game the system, I guess, so to speak, would be one way to say it. You can do it, but there's a consequence for everything. This would be the shape of the trade if we did open it with a credit. And you can see that I did it almost right on the line, but I didn't have to, right? This peak here, I could have shifted that to the right, say, 6,500 in the SPX, for an example. And as long as we stayed below 6,500 in the SPX before we expired, then this trade would be a profitable trade. This is one of those trades where we say we're not trying to pick a direction per se. We're just trying to define where the market shouldn't go, right? Like if I thought we were going to fall a long ways, I would want to monetize that by maybe buying a put, and if I thought the market was going to run a long ways, I would want to monetize that, maybe buy a call. But that's different than saying, I don't think we're going to go up farther than this, whatever level you choose, or I don't think we're going to fall lower than this, whatever level you choose. That's often a lot easier to perform as a diagnostic function or doing technical analysis. A lot of times it's just easier to say, hey, support's right here, and I think that support's going to hold. Okay, great. So you don't think we're going to fall below that level? In what time frame? You put a date to it, and now you've got a trade. So a calendar like I just built here can maneuver from that function. And this is a unique calendar. Calendars generally have the shape of a butterfly, only they're more rounded or curved. Butterflies are very strict, very straight with sharp angles and lines. And a diagonal looks like a butterfly most of the time, except more rounded. And this doesn't look like your typical one. And that's because we got it for a credit. It flattens out into the amount of credit that we collected, and it doesn't ever go below zero on the left hand side. So these are really good trades that are easier to put farther out of the money, I guess is a good way to say it. If we, sell a credit spread far out of the money, we don't really get much credit for it. And let's say it's a $5 wide credit spread, we collect 35 cents. Let's call it 40 cents for easy math. Now I'm risking 460 for a chance to make 40 cents, and I'm stuck in the trade waiting for that thing to mature, and it's just a horrible trading practice. You can easily get ran over. There's not a lot of ways to defend them because it's already a spread built to mitigate your risk. Whereas with these, each leg is independent, so you can turn each one of them into a vertical. They're not in the same expiration. like a regular vertical is. And so you've got a lot more ways to protect the trade or defend the trade if something is going wrong. Looks like Jeremy's doing a little chit chatting. He said he is selling to open TNA with August 8th expiration, 35 strike put, and he got almost $1. So this is TNA, it's a Direxion ETF, and selling a put at 35 says that he thinks it'll stay above 35 or that it won't close below 35 by August 8th. And if he's right, he gets to keep $1. If he's wrong, he gets assigned the shares at $35 a share. That's not a bad trade for $1. It's been it's tested the 20 period and held. Um, we still got 4, 10, 20 stacked on top of each other, although it does look like the 4 is about to cross. If we look at it, over here where it's normal moving averages. And even if we did break the 20, like we did, say, back here, it's very likely that we'll break it and then we'll come back up at least once, right? And we'll bounce into the bottom of that 20 period moving average and set a lower high before we fall again. The concern is to bounce and set the lower high and then fall back down. That would take time, like we did, back here. Well, that was a higher high, but you get the idea, right? We bounced here and we set a lower high. It takes time, a couple of days, and we might not have that in a 9 days to expiration trade, right? Trade expires here. We don't have a whole lot of time, but that could get it done. Um, let me see if he wants me to post this. Oh, let's see. Good times, good times. All right. So we'll see. I'll just keep moving. If he responds, then we'll go from there. Let's see. So generally speaking, I like to do mechanical trades on index products, mostly the ETF indices, but the sectors too. Say that the Spider ETFs or Drexion. It's no real big difference other than liquidity. Most of the traders that I know, though, have a particular preference. And if you don't have a preference yet, it might help you out to kind of look around and decide what group you really like. Spiders have always been a preference to me just because I was introduced to the SPY really early in my trading career. And so I looked into the SPDR ETFs really early in my trading. So I was just influenced by these guys a lot when I was starting out. They've got a awesome app for your phone or tablet. They'll send you weekend emails doing a sector review and a sector summary, all free, right? It doesn't cost you anything. They they're just a really nice company to work with. So this is mine that I like to use, but um, most of you probably don't remember Dan. He was one of the founding members of the Bullish Bears. He liked a completely different group. And I want to say it was, oh, the ones that do the VOO in their ETF, Vanguard. He really liked the Vanguard series of ETFs. And that was his go to. There's no wrong way to go, right? Like you can use whatever you want. The VOO is the SPY, basically, right? It's the S&P. It's not going to be, penny to penny perfect, but same deal. So pick the one that you like, do a little bit of research on it, get comfortable with them so you can recognize their ticker symbols, use them for your research, sector evaluation, sector rotation, that sort of stuff. When it comes to doing calendars and diagonals, these are my go-to. I'd much rather do it on these than equities. Equities, they get those surprise headlines that run you right the hell over. They come out with a new product launch, CEO gets arrested, Boeing airplanes falling out of the sky. There's always something. So I like to focus on these. And it's not to say that you can't get a good trade once you know how to put on a calendar, that you can't put them on somewhere else because you can. And from time to time, I'm willing to do that. But when I'm running mechanical trades, I keep it in the sectors and in the indices as much as possible. Mechanical trades are ones that you open up for a predetermined reason, and it doesn't necessarily have anything to do with price action. I've run trade strategies that put on, for an example, long calls on Tuesday around 11 o'clock just because it was Tuesday at 11 o'clock. Like that was the whole strategy. Buy a call for less than $5 in SPY every Tuesday at 11 o'clock ish. Didn't have to be, spot on right at 11, but around 11. I don't even think you can get um, calls nowadays on the SPY for less than $5. I was using a 1 week to expire option. So here it is Tuesday for an example. Would just go out 1 week. Oh yeah, hey, they're $5 again. It used to be easy. And then COVID hit and these, they went from $5 to like $9. And so then I had to adjust my strategy to do call verticals and it was okay. It reduced the return. So I had said last week that I want people to feel comfortable putting this trade on. I really want to make sure you guys know this trade. It has so much value to you as an options trader. And sometimes when you're long a call and things are kind of stalled out, they're not really working for you. The fact that you understand this trade helps you grasp the idea that you can try to fix that long call with a short call or puts, right? We can do this on the put side too. If you're long an option and you have time, that you can go in front of that option and sell an option at any time, even if the trade has been doing good, right? Say you buy a call, the market runs up, and you're like, that's fantastic. Should I close it? Oh, I don't know. I think we might get more out of it. Well, I'll just sell a call in front of it. All right. So knowing how to do this trade offers a lot of opportunities to you as a trader. And it's just a really good trade, much better, in my opinion, than a vertical. It's not to say that you should never do verticals, right? They each have their time and place. but it's a good one. And I've come to the realization over the years that traders, when they're trying something new, want to know that they're doing it right. They want to know that they're doing it the way others are doing it. And I figured, well, let's just put the trade on. I'm going to put one on and I'm going to show you how I do it, what strikes I pick, and why I picked them, and work the order and get it filled. And if you want to follow me in that, great. That way, if you're in it with me and the trade's not working, we're going to have another stream another day. We'll fix the problem, try to roll it, adjust it, manage the trade in some way, and then eventually, we'll get it closed. So that's the goal. And of course, we'll talk about anything you guys want to talk about, right? I'm fair game, whatever. But if you don't have any topics that you want to hit on, then let's do this and find a trade. I think I've got a short ETF list. Not my big long list, just a short one. Maybe I might have deleted the darn thing because I had my bigger list. I bet I did. And it's not a big deal. We'll just make another one real quick. Oops. What are we missing? Industrials. We'll do them in order. We've got financials, technology. Come on, sort. Financials, technology, consumer staples. Next row, industrials, building materials, and energy. That's what we're missing, energy. Then the last row, uh, commodities or staples, healthcare, and utilities. All right, so that's the 9. Now we can spread that out a bit more. There's like metals and mining, so XME, and they've got a real estate one, which by the life of me, I can never remember. So just going to bring this up, XLRE. I never trade that one. And XLC, which is communications, just because it's trying to spread out, the difference between tech and communications. Now, I really like this semiconductor one. It's not um, Spider. I think Spider needs one. Yeah, XLC was a boost that they brought in with XLK, right? Tech is just generically speaking tech. They brought in communications a few years later, XLC. It wasn't to replace tech. It was supposed to like enhance, spread it out a little bit. And then chips. SMH is not a spiders ETF. We need a semiconductor ETF from the spiders, and that's what I was looking for. It's XSD. Yeah. Yeah, it's not real popular. I've never traded it, but I knew it was out there. So that's why I had to hunt for it, right? Like it's not even off the top of my head. I couldn't remember what it was. Now you know why I don't trade it very often. There SMH is my go-to semiconductor one. Yeah, I mean there's a few differences. It's not not by much. The main thing is just putting together the list for everybody and showing that they're out there. I'm gonna trade liquidity more than what the chart is doing. You know what I mean? The candles, I don't care what the candles are doing. If I can find a trade based on a decent price, that's what I'm gonna do. Right. So we're just gonna jump through these and see which ones have liquidity, hopefully more than one, and then we'll go from there. So just alphabetically, we'll start with B. Really? Zero? Nothing? Did my think or swim freeze? Are you awake? It's awake. All right, XLB, zero trades today? That just doesn't seem right. Building materials, but zero trades? I think my think or swim is screwed up because I'm jumping through mold. There it goes. Now it's starting to move. Okay, we can see communications only has 500. Um, Energy, nothing. Oh, there it is. 34,700. Financials, 112. They're getting a little better. Industrials only 11,000. 7,000. Oh, goodness gracious. All right, so I think XLF won with 112,000, and that doesn't hurt my feelings anyway. This is a $55 product, and it has 50-cent wide options a lot of times. We can see here 50-cent wide. So, we can put on a relatively small trade. That way, even people with small accounts should be able to handle this. Um, so, that's right. That's right. And I used to wheel it when it was cheaper, like back when 25, $30. And I've gotten assigned multiple times on this. It always went really smooth. There was just, no issues. Deliberate assignments, you know what I mean? Not like surprises, not like UUP. I swear every time I trade that thing, it's a surprise, assignment. They're like, ta-da, gotcha, sucker. I quit trading that darn thing. That's the dollar, by the way, the UUP. It's like a dollar triple or dollar double. So let's look around at where most of the liquidity is at, not just where things have been traded today per se, but where can we find the open interest across the different expirations. So I'm going to log in. We don't have to log into any external tool, but I already have an external tool, so might as well. I'll show you guys a neat little trick for how to do this if you don't have a nice little tool. Open all of them up and then focus on your open interest. Now I've got a really nice mouse that has a speed mechanic scroll to it. I can just spin the wheel and it'll go, right? It'll just go and I can keep my eye on those on that open interest as we go. I run one way and then I run back up the other way and I can see both sides and try to spot where there's a big pool of liquidity. That's one way to do it. But it's nicer if you can just bring up, some tool that has it plotted out for you. And I think even in the Discord, there are Discord tools that you can just call up the current open interest. You can go that route too. So let's check. Yeah, open interest for, let's try this one. XLF, expiration, all. Ta-da! Open interest for XLF, and we didn't even need to go to a fancy website. So we can see that $52 and $55. Well, it's probably 50. Yeah, 55. We'll check, but this shows us open interest. It doesn't tell us what day per se or what expiration, just what strikes are they focused on. So it's a good start. Let's nerd out a little bit more though, get a little bit deeper. This isn't available to the public yet, so if you go looking for it, you're probably not going to find it. But you could bring up Trading Ticks or Spot Gamma or something like that. And we want open interest. So January, December, September, and October. It's not much of a surprise, right? October is a little early, but I think we're going to start there. And if we don't find anything in August, then we'll jump to September, right? Well, let's have that as the plan. It's not a surprise, right? I guess the only real surprise is that October and November was really light. It went from September straight to December and then January. But whatever, you know what I mean? Like that's the whole idea of looking at those tools is to see what we can see. Never know what you're going to find. Just you want to start with just by looking around. So we'll close all these up. We'll focus on the 15th, which is only 17 days out. It might not be enough to even find anything. Now that we've picked a product that has liquidity, let's go out and take a look at the chart and see what we can see. You never know, what we're going to find. I think that's a bit noisy. Let's just turn this stuff off. That's better. I don't think we're in log scale mode, so should be fine. We've got higher highs and higher lows, and we've been running in a grind higher sort of swinging trend, especially since this last gap. It's not the last one. Actually, we had another one here 2 gaps ago, back in May. So there's our swing schedule for the moment. And unless we break ranks and run back up to retest, we should complete the swing. So a call credit spread or a call calendar up here kind of makes sense. We're not bearish on this. We're just short term, not bullish on this. Two different things, right? If we complete the swing, then we should be focused on something down here. Say we had that. We're not looking for perfection, right? This doesn't have to be an art project, and we're not looking for precision. It doesn't have to go to the penny anywhere. We just want to focus on what we don't want, and that would be getting challenged across the highs. So before we even go anywhere else from here, we need to make decisions about what would tell us that our trade is wrong, that our analysis is wrong, or that something has fundamentally changed within the trade and we no longer want it. I bring this up because I see in the chat from newer swing traders when they have a trade, it's been on for a while, and now they don't know what to do with it. You would think that we only see those questions from losing trades, but unfortunately, we see it from winners and losers where they're just surprised, like, hey, this trade worked out really good. Should I close it? Should I keep it open? Maybe double down, add some more? What do I do with this trade? It's way too late to be thinking about that question after you've already been in the trade for a while, winner or loser. Kind of want that answer before you start the trade. And the reason why is, well, we're all human and you will get greedy. You're going to get scared and, you're going to get shook. So, to avoid the whole fear greed complex as much as we can, we can't avoid it completely. We want to try to have a plan in place before the game even begins. But you know what's that plan? That phrase about plans. Everybody's got a plan until they get punched in the mouth. Something like that. I don't remember who said that, but maybe Ali or someone. I don't remember. The same thing with trading. You can have a plan, well intentioned and everything, and then it just goes off the rails. But at least try. So if this is supposed to complete the swing, it's very likely that we're going to set a higher high. So, right, it should turn somewhere up here and not even get down to this low. And that means if it does turn somewhere up here, Mike Tyson, there you go. I didn't know he was so eloquent, but hey, give credit where credit's due. It's a nice quote. He does. That's a surprise, but I'll have to check it out. I guess if you just listen to it in the squeaky voice, right? They always make fun of the way he talked on like Saturday Night Live and stuff. To the Google. I wouldn't do that either. He'd probably punch me in the nose for trying to make fun of him. They removed all the bone structure on my nose. I just got loose cartilage now. It wiggles around. You guys can't see it. I'm wiggling my nose around right now. You can't see it. It's silly. That's what happens when you get punched in the nose too many times. So if we do turn early, we're going to be challenged early, right? We can't count the days here and say like, well, that took 9 days. Yeah, but the next time could take, 5 days. We don't know. And when it comes back up, we've been making higher highs. The assumption is that when we turn, we should make a higher high. Granted, this last high wasn't much bigger than the last one, but it was higher. So we don't want to put our line in the sand and say, well, if it gets above 53 and a half, we're going to kill the trade. No, 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 no. Let's give it a little bit of room. All right. We don't need precision. We can give it a little bit of wiggle. So at the bare minimum, I'd say we throw a fib on it and we find where the reversal zone is and then round that up to an options level. So it says 53.75. I can't put on an options trade on the 75, but I can do the half, which is a little too close for me. I'm not interested in that. Or I could do 54. I think what I'm going to do is move the fib up there because that just captures the current swing. And that says 54. So I like 54. If we was to run it all the way down here, we get 54 and a half. And I just don't think there's going to be any money at 54 and a half. We can look, but I think it's too far away. When it comes to these cheap options, you can't really get too far away, right? It's just they're just really cheap options. There's not a lot of money in there, but we'll look. So a line in the sand says if we get above 54, I want to reduce my risk. And if we get above 54 and a half, I want to just go ahead and close this trade down. Now, I'm not talking about, hey, we wicked up there, at 9:30 in the morning, let's close this trade. I'm talking about near the end of the day or even sometime through the middle of the day where we've gotten above 54 and a half and it doesn't look like it's slowing down, turning around, consolidating or anything, and that it looks like it may close near the high of day on that day. The reason I say that is a lot of people will say, well, if it daily closes above 54 and a half, we're done. Well, the next day we will close it. Okay, I mean, I get that, but if it's clear as a bell to you that it's not going to come back down and drop below 54 and a half on that day, why not close it that day? Why wait till it closes and then come in tomorrow, get past the open and sometime around 10:30, then you're closing it. Sometimes it is obvious and you're like, yeah, no, this is done. It's just not going to work. And let's just go ahead and close it. And sometimes it's not. So we'll have two conditions: close it above 54 and a half, either on that day because it's crystal clear that it isn't coming back down below 54 and a half. Or if we're not sure, we'll let it close above 54 and a half, and the next day we'll come in and we'll close it after we get through the open and the violence. So around 10:30 or so, we'll close it. Above 54 is just where we're going to start trying to reduce risk. We can do that a number of ways. We can close some positions if you got more than one. We can consider rolling things, adjusting them, adding something to the trade to reduce risk. In some way, just trying to reduce our overall exposure. And for the profit side, depending on whether or not we're going to open this as a credit, we'll focus on hitting percentages. When I sell to open something, I like to focus on percents like 15%, 25%, 35%. On debits, I don't run quarters as much. So, 25, 50, 75. On debits, I tend to run dimes more often. So 10%, 20%, 30%. These are capped trades unless you break it apart along the way. So there is a max profit to it. It's not like buying a call where the sky's the limit and you could make the moon. That'd be nice. Um, these aren't like that. They will cap out, and that's as much as you can get. And you should never aim for max profit, anyways. So we're looking at a short term short in XLF, very likely using calls for this diagonal or a calendar. And we're going to price it anyways just to see what the model has to offer. We might price some puts at, say, 51 and a half because it should not give us that lower low, right? We should get a higher low if all of this is going to continue. My concern at the moment is what's happening with the BOJ and some liquidity issues. But this isn't really the forum for that at the moment. But they just agreed to cover, right? So they're gonna they're gonna lend government debt on spot price, and when they start doing that, it's gonna start getting into a liquidity issue. Another day, we're working into risk, right? That's the long and the short of it when it comes to the JGB and BOJ intervention. Wow. You know what? Maybe we should cover it. It applies to this trade. With BOJ intervention, the threat is an S&P ripper, right? Up, not down. It's more up. And that could just run us right the hell over. You guys remember 2022 bear market? Let's see if it affected the XLF. Let's see. Let's see. 'Cause this is going to go to the heart of our trade here. We were in a bear market 2022 and things were looking kind of ugly. And then a little bit of a wink and nod was done with Powell and the Bank of Japan. And suddenly we were off to the races right there. That big down day with the big blue bar in it, that bar right there, that was the day. That was intervention on the JGB. And I did a video on it. It was the biggest trade of my 2022 trading year. When the S&P moved like 8 points in 2 days, maybe 3 days. So this is the threat to our short call, right? If we were to come in and add a short call up here. But let's start looking at some prices, because when it comes to these options trades, they are defendable, and we can we have a naked call that we can roll, and we can just roll it up for more money and more money and more money and more money. I like that. More money sounds good. We just have to also roll the long call, right? And since you can't have a short call behind you, you have to have a long call behind you. There's a couple ways to do that. One, we roll the long call first, and then we roll the short call second. Kind of sucks, but that's the way to do it. Or you can roll them as a unit. You can always do that. So we're looking at 53.5 as the high. I didn't tell you to change charts. I don't like it when Thinkorswim does that. It probably does. And since we're not doing the puts at the moment, we're going to change the filter to only the call side. All it does is just hide the puts from the options chain, and it spreads everything out so that if we wanted to, we could add more things across the top, right? And that's what I want. I want to add more things. We got open interest in gamma. We want delta at the bare minimum. Let's see what else I wanted to put in here. I think that's pretty much it, but maybe we'll do some changes in open interest and maybe volume sizzle, although really not needed, right? Not needed. All right. So we could see this 75,000 to 200 in open interest. Between all of yesterday's trading activity, 219 trades were carried over and added to that. So when we came in yesterday, there was 75,001 contracts here. At the end of trading day yesterday, 219 more were added, and that's why we got 220 total today. Although yesterday, we had 175,000 something, it looks like, traded. Only 219 were kept. Wow. Let's open this up. What I want to do? I want to do that. This gives us a chance to chart that option that we're looking at and look at its volume and open interest. We can see the open interest on the weekly where they came in and really started to load it up back here on the 21st. It's been around for a little bit, right? So this contract, it's not new. It didn't just show up out of the blue. And that's nice to know, right? Like they'll come in and specifically make an ETF, not ETF, but make a new strike, and then they're just there's no history behind them. There hasn't really been much trading on it yet, and this gives us an idea of what's been happening in this option. It's it's not going to tell you to trade anything, right? It's more of just giving you info so we can make a more informed decision. And it could help us define our stop. If we were to sell a call using that 53 strike and it doubled in price to 120, then that means it broke this previous resistance level. And that would probably be a good place to set an alert is $1.20 on that short call. We're just setting an alert, not talking about closing the trade out, but it would get my attention. If this thing um, got above $1.20, one, because it would be more than we sold it by 100%, but two, it would mean that it broke that resistance level. They should be, yes. And um, I hate to say it that way because then it's like, well, maybe they are, and maybe they're not. You know, they're kind of new to me, like, and by that I mean less than a year old. So just to make sure, why am I doing it that way? We can share these now. Back in the day, you couldn't share those. Um, which one is this one? I'm going to just put them in the chat. And I think these came from I think they came from Mentor, but I'm not 100% sure. So, damn it, I did it again. I'm gonna say they came from Mentor, and if I'm wrong, then my bad. I'll find out if it really matters to someone where they came from. The thing is, I didn't make them. That's the number one piece, and that I've adjusted them a little bit as well. They're not originals as they were developed by the creators. Sizzle's mine, however. I did make this one. And this is implied volatility sizzle, not volume sizzle. Key key piece. It only says vol sizzle because there's not a lot of space when you name these. But um, if you want to find a way to reduce that to where you could put OI sizzle or something like that, it might have a better advertisement when you look at the header. Or IV sizzle. Yeah, let's call it IV sizzle. All right, that should be the four. One, two, three, four. And I've got others. Just remind me, and I will share them. There was a write up that came with these, and it wasn't very accurate. I literally took the code, gave it to AI, and said, please explain this code to me. And it did a much better job. Like, there's cumulative delta in what I just shared you. I can't remember which one it is, but obviously it's one of the volume ones. When I told AI, "Hey, read this and tell me what this code is doing." It literally described cumulative delta in the options. I was like, "That is really cool. Thank you." I didn't know I had cumulative delta in the options chain. Appreciate that. So yeah, that's pretty neat. So I like 53 and 54, from out here. And we want a little bit of money, obviously. Selling 53 is good, but we're under 53. So if we can get in the money just a little bit, get a little bit more, I'd like it a little better, right? That thing has lost money since I've been running my mouth. I should have just got it 20 minutes ago. We'd have made more money. Nah, it's okay. Um, my concern is 52 might be too low, right? 52 and a half, I suppose, but it's not even a dollar. 90, we can get it for 90 cents, work the order. So let's look at August 15th, 52 and a half, which, the open interest is not impressive at all. But if we want the money, then, we might have to do that. Let's, we're going to try a couple here. We're going to try 53 because it's got way more open interest. This is for the 15th. So we're going to go, see if we can find any liquidity here. Yeah, we got some. I'll be dang. Let's try this one. It is just a little farther out. If we have to, we'll go a full week out, but I don't want to. So we're going to buy the 54 on August 22nd. And that's going to put us in a credit and we'll put it in the analyzer. Now we're not going to analyze it yet. We're not done. We we don't want a 53 because there's no open interest. That would have given us a calendar. And we're done with that expiration. So we're going to go to the next expiration, right? Close the 22nd and look at the 29th. There's nothing here, so we don't need to worry about analyzing a trade on the 29th. And then we have the 5th. Ooh, that is broken. We don't want anything from the 5th. And that leads us to another uh, OPEX. Now, technically speaking, I don't think we can run a 52 that's going to even remotely look good, but we're going to try it. So um, we're going to try to buy a 19 September 52, and we're just going to throw it in the analyzer, right? That one's an actual debit. And now we're going to look at something that's more reasonable, a calendar, a 53 strike calendar for the same expiration, September 19. That one is also a debit. It's a little smaller. We'll throw that into the analyzer. See if there's anything out of the money here. Look at all that open interest. It's so beautiful. Let's try the 54. Lots of September opportunities. I just hope we don't have to go that far out. The the thing about a calendar, and I'm going to demonstrate it in the Analyze tab, but the farther away the two expirations are, the more different it performs. If you have a short option today and then one tomorrow, like in the SPY or the QQQ, calendars and diagonals function completely different than if you have days or weeks separating them. So just kind of keep that in mind. The separation in time is really important. So we've tried those. I threw them into the analyzer, and now let's discuss this topic of multiple expirations separated by time. So I've got the blue one here and the blue one here. Those are both OPEX expirations, monthly expiries. And I'm going to just use my drawing tool here and highlight the August 53 and the September 53. Now, Price wise, even though it's the same strike, this one has $127 and this one has $61. That makes sense because the August ones are going to expire sooner. They have less theta in them. And then there's the theta decay, which starts out kind of gentle. And then as it gets closer to expiration, it really starts to tank. And that decay is important because this one in the front, it's going to get into that downward curve a lot sooner than this call will that's out at 52. Right. So the 117 days to expire, it's already started that really swift part of the descent. And the in the next 3 or 4 days, it's going to be like down here where it gets really swift, right? Whereas this one is still higher up on the chain and it's falling, but it's not falling as fast. That's a big piece of the entire puzzle is that the front one is going to lose its theta faster. It's got a faster rate of theta decay as opposed to the one farther out. If we were only going to do like a calendar or a diagonal focused on the dynamics of the way it was built without trying to fix it or run spreads or do anything else other than open it as a calendar and close it as a calendar, then that would be the number one thing that you would want to focus on is the differential between those two. But we've got more than that, right? Because we've got the ability to add strikes and roll things, and we can pimp it out if we need to. But if we trade it as a single unit, literally as a calendar or as a diagonal, which you can see that's what the platform called it when we built it. It called it a diagonal. But technically speaking, that's just a name. It doesn't mean anything. Back in the day, you had to call your broker to put on an options trade. So then you would be trying to articulate to that person on the phone what it is that you wanted to do. I want to buy this one and I want to sell that one, but I want one at this date and one at that date. After a while, they started coming up with names for these kind of trades. There's an old story about how uh, a group at the CME would get off work and they would go up into the break area and drink beer and chat, and kind of hang out waiting for the streets to thin out a little bit before they would go home just to, kind of avoid the rush hour. And they would write down names for these different trades and they were just throwing them in the center of the table, right? And on these little pieces of paper. I don't know if that story's true, but it's one of the stories that I've heard over the years. And so this diagonal, it is just a name. If we keep the trade intact and we never break it apart, then we want to continue to use this image. And we're just going to pick one of these for the moment, this one, and point out, you see how different that is? It doesn't look like a butterfly at all. It looks like a vertical with a little bump in the road. Whereas if we look at that one, it looks like uh, a bit of a butterfly. We can see some butterfly characteristics, and it does go in the negative at some point. So keeping the trade completely intact as a diagonal or as a calendar, it will keep this shape. But at any time, we could turn that long call into just a long call all by itself because all we got to do is buy back the short one. We could take the short one and we could just add a long call in the same expiration. And suddenly we don't have a naked short call, right? We sold or we are going to sell that 53 and protect it with a farther dated 50 something option. But we don't need the farther dated one at any time. We could just come in and buy an option somewhere around the one that we sold. So if I have this 53 and I buy the 52 or I buy the 54, suddenly I've got a call vertical, either a long vertical or a short vertical, but I've got a vertical with a long call all by itself now, sitting out in September. So we can break this thing apart and it won't be a vertical at all. It'll just be a vertical and a single, or two verticals if we want, turn them both into verticals. We can roll them together into the same expiration. That way we're not adding contracts, we're just putting them into the same group. So many ways that we can adjust this trade. So iron condors, iron flies, butterflies, they're just fancy names. But at the end of the day, once you start adding contracts, it can be whatever you want it to be. And we always just want to focus on what's my risk. When you journal trades as an options trader, try to keep track of how much are you paying for each contract that you're getting. Not the group. This is a $27 trade, but how much was the 54 and how much was the 53? That can be important later on if you're trying to manage the trade and you need to buy it back, or you've rolled it and now you can't remember what it was when you originally opened it. My broker, Tasty Trade, does a really good job of keeping track of that information, but other brokers do not do that very well at all. So you want to keep a little journal. And for me, taking pictures is the way to go, right? So you can build the trade. Say you got this 53 short and you got this 54 long, and then you can take a picture to where both of those strikes are showing so that you can see their prices and you can see the price of the trade. You get something done like that, just like this right here. I have all the information I need. The trade was this much, that call here was that, and that call was that. And then I just throw that in the journal. I can refer back to it at any time and see, what did the trade originate as? I get people who ask me options questions all the time, and they'll have something like a 10 lot, and they'll say, "Hey, I collected $420 in credit on this thing." And they won't tell me anything about lots, right? All I hear is, "Hey, I opened a vertical on XLF and I got $420." And of course, I'm thinking, how the heck did you get $420 on such a cheap ETF like XLF? Oh, well, I had 10 of them. Okay, well then you got 42 cents for that option, right? I don't care how many you had. It has no bearing on the trade's function and the way that it works. Or they'll have no idea how much credit they got or how much debit they paid to open the trade. You really need those numbers if you're going to fix it later on if something goes wrong. So use an Excel spreadsheet because you can put pictures in Excel. Use that, use Discord, do something that gives you a chance to journal the trade, especially if you're going to do the wheel or something, so that you can keep track of the premiums that you've been collecting. So we got these trades built. Now we need to figure out which one we want. We're going to start with the one that was a credit because I really like these. They've always been fun. But if you can't see it yet, there's a downside to this one. Here is the loss zone, and here is the profit zone. That is at least 2 to 1, right? You're risking two to make one in this trade. Now I get it, options trades are not things that we put on where we focus on, risking one to make two. That's not the place for options trades. But you still want to recognize your risk models. These have a higher probability, so you don't need to risk to make one, right? That's just not the dynamics that they need. And it is a sell to open. So what's my risk here? we can set the option expiry at break even here. So when it's doing this, it's asking which expiration do you want? Because you got two. Pick the later one. So here's the line in the sand, 53 and a half. That's what we need price to close below on expiration. Now remember, we can run up there and dance and play, but we just got to get back down below it before it expires. And better still, it just never goes up there at all until after we get that short one closed. Then it can go up there. If we didn't like this one, we could shift the entire trade higher. So this one, it runs along and it peaks and then it falls at 53. Well, of course, we could flip that strike out from 53, roll the 54 up to like a 55 or a 56, and then move the 53 up as well. We could also just move something like the 54, kick that one up a little higher. So this trade collecting around 30 cents is risking 70 cents. It's a $1 wide trade. We need to account for all of the money. If I can collect 30, I'm risking 70. If I only collect 27, then it's 73, right? But whatever, round it's close enough. That is awesome. Thank you. Jamochas. Haven't had one of these. We've been getting the McDonald's ones so much lately. But yeah, Arby's Jamocha shake. Yeah. It's so hot out. So that one's not bad. I like it. It keeps the risk down, but there's not a lot of money in this one, right? Now we're seeing $27 and talking about it as if that's our profit goal. It is not our profit goal, right? Remember, this is two different trades. We have a long call and we have a short call. And while if we keep it contained as a unit and price falls as we expect, then $27 is what we could expect no matter how far down the market falls, right? I can just keep going like all the way to zero. We're still just going to make $27. But what we want to focus on is closing the short call and possibly leaving the long call on for more. And of course, we could just hit the sweet spot here in this little bump, but it's not much of a bump, to be fair. It's a really cheap stock, right? So, and we're not far apart, so there's not much of a bump. What was the price of that option? It was like 60 something when we were looking at it. There it is, 60 cents. We want to aim for at least half of that 60 cents, if not more, which to be fair, 27 cents, 30 cents, pretty close. The difference is to get that 27, we would need to stay in the trade all the way to expiration or dang close to it. But if we focus on just this short call at 60 cents, how it moves and decays and the values that go with it, we can just monitor that price until we're ready to close this trade. And as long as everything is moving in the right direction, we can close that at 15%, 20%, whatever, right? Then we'll focus on the long call separately. All right. So 60 cents is what we could make from that, but that you won't get 60 cents unless you hold it into the close. So unrealistic to think we would get all of it. Although I do know traders who do that. I'm not a big fan. Now what we need to decide is, are we going to leave the trade intact and close the whole thing as a package or not? And if we don't, what's the rules to close any of the legs early? Let's look at this next one. Somehow we got flipped around. Let's see, September, August, September, August, August, September, we got that one right. It's way down here. We'll circle back to these others and flip them around the way they're supposed to be. All right, 54.53, $16 in debit. Big drop down here, right? If we're collecting 16, basically 20, then we're risking 80. So we're risking 84 cents to make 16. Or actually, it's not even, it's a debit, not a credit. So if it falls, the worst we'll get hit is a $16 debit. This requires more precision. We're going to need XLF to actually find support around that 51 or 51 and a half. So this previous low, remember as we talked about, if we're making higher highs and higher lows, we should not make a lower low here. And that fits the 51 and a half break even line here, or a negative line, the break even line. So we shouldn't go below that. If we close below 51 and a half on a daily, and we the next day don't open and get back above it, then I'd say we want to manage this trade. We would want to start exiting some of the trade. We don't have to close the whole thing out, but we want to reduce risk. If we get a close below, we could use the actual dollar amount, 51 and a half, or we could use just this lower low here. I think I'm going to use price action itself and say if we break that low, because it's been a pretty stubborn low, right? You can see how we opened on that price and then we bounced on it this day and then we bounced on it this day. So if we candle close below it, the next day I would look at reducing risk. And if we get below this gap down here, and candle close below that gap, then I would get the position closed or manage it in some way, convert it, roll it, modify it, do something. Because below this on a gap close, it's time to change position, right? But the downside isn't the problem. The worst that we're going to get with this thing falling uh, is $16. Some of you might be thinking, what do I care? I don't even need to roll that, adjust it, nothing. Sure, if you've only got one, I agree with you. Well, I'm not going to, bend over backwards to adjust the trade if I'm only going to lose $16. But if you've got 10, 20, 40 of these things, you're going to probably going to want to reduce risk a little bit, right? So that's why we're talking about it. It's the upside that's the problem. What you post there? Right on. Let's take a look at that. 55's got a lot, huh? Some positioning there. Ah, let's see. Well, that image isn't wanting to load, but that first one loaded. Let's see if I can try that again. Yeah, there it goes. It certainly could. So, um, this one, $16 risk to the downside. It has $84 of risk to the upside. And the break even line on that upside move is $53.50. If we look at the chart at the upside move, 53 and a half is all the way up here at the top. And it's like we talked about. I would want a buffer before I would consider, any sort of reaction to close the trade. I don't want like a hard stop up there or something like that. If we candle close above $54, then I would start to be concerned. Let's see. $54 is just a little bit past that break even. So at 54, I'd start reducing position. And at 54 and a half, I'd either want to close the trade or completely remodel the trade. And it has to be a candle close, or we get so far beyond it that we're pretty comfortable with the idea that we won't fall back down the same day. All of that is based on the logic that we don't want to get one of these sort of fake out moves, right? Where it pops up and it falls back down, and that's a Friday expiry right there. So this would have been one of those where on a Thursday, say you're short on the 50, it spikes up and you're thinking, "Oh no, I got to close this trade." You close it as a loser up here, and then the next day it falls down and closes below your level, and you're thinking, "Well, golly gee darn it, if I'd have just left everything alone, it would have been fine." So if it's above 54 and a half and it's continuing to run to the upside, we're, you know, probably pretty confident in managing it. Otherwise, we will wait for that day to close and to see if we open the next day above that level or not. If we do, then after the morning session, we get it closed. Now, all of this has been a discussion on just looking at XLF, and we chose this out of all of the sectors because it was the only one with liquidity. And we picked a direction simply because we were topped out and calls were easier to defend than puts, right? I didn't do any technical analysis. We didn't look at the banks. We didn't, talk about earnings. All we looked at here was if I build a call spread at that level, then I can defend it a lot easier and I'll get more credit than if I was to build a put spread all the way down here. I'll get way less credit for that and I'd have to defend it against all of this risk. So a lot of times when it comes to options, that's my approach. If you listen to someone like Tom Sosnoff, he says technical analysis is a complete waste of time and that nobody can anticipate what price is going to do next. It's a random walk. Now, to each their own, right? I am fairly comfortable with my intraday trading on where we're going to turn and when we're going to turn and how we're going to turn. But when we get to swing trading, I'm not going to say that I'm a firm believer of Tom Sosnoff's philosophy, but he makes some good arguments. So we can scratch our head and get out the Ouija board and try to crystal ball, if it's going to go higher or lower or when. But at the end of the day, just let the risk define your position. I'm looking at call spreads here simply because it's the one that offers more profit with less risk. That's it. If I was to look at the charts and try to determine bullish and bearish and blah, 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 it would probably lead us to the put side to, like sell puts or something. And that's probably true, but just focus on risk. So, I mean, a lot of quants would say yes. So I brought up trading ticks here since we're going to bring in some alternative information. And we want to look at the dealer deltas down here. That's the bottom section. And it's this side. There it is. Now, if we think about it, um, the dealer is who took your trade, right? So if they are net short, then the broader market, you, me, consumer, the average retail is net long. They've been exiting out of their net long, and so dealers have been exiting out of their net shorts. It really is as simple as that. We can complicate this page a heck of a lot more if we need to, but we don't need to, right? That's the long and the short of it right there. And we can see how that worked in the past when price ran up and hit a previous resistance level and it just kind of stalled out there. The market, who had been net long, said, screw this, I'm out. And they went net short, which put the dealers net long, and down we went. Now, you could argue that the dealers sent us down there or whatever. This isn't a cause and effect scenario for me. It's not at all a cause and effect scenario. It's more of just recognizing what do we have, and if it changes, what should happen next. If we're seeing the dealers net negative and they are reducing their positions, then the market is reducing their long exposure to XLF, likely based on the idea that they think we're going to go down from here. The market can be wrong. They've been wrong before. They will be wrong again. But if they're lightening their load against longs, I'd say let's join the party and put our call diagonal up here, right? Short term short. We're not saying that this is going to go down and crash and burn, just that the run up is stalled and we want to make a little bit of money on it. Makes sense to me. It's like we said at the beginning of the stream, we can be long, short, long and short, but not sideways, sideways and long, sideways and short. We can be any of those combinations that we want. And it's a lot easier to say, I don't think we're going to go higher than this point in the next 3 weeks than it is to say, I think we're going to go to XYZ price here or here in the next 2 weeks. Because that's a lot harder to do. It's doable, but for newer traders, focus on the easy stuff. So I like my idea of capping price for a little bit. This trade has a little bit of risk on the back end for sure. $84, but only if you held all the way to expiration would you actually lose $84, right? Like, you don't, that's not your real risk because you can manually close this thing as long as the market is open. So we should say at 50% of max loss will close, 60% of max loss, something, right? Put a defined line in the sand there. Now that we've talked about the loss, how much money could this trade make? All things being equal, max profit in is about $45. Never anticipate max profit, by the way. All right. So if we're being realistic, say half of that. So $42 ish. If we're going to risk half of 84, which is 42, then we should, try to make half of our max, which is 22, right? 21. That's risk two to make one again, but the probabilities are much higher on a trade like this than a straight buy to open, sell to close trade that needs a 2-to-1 risk reward. So, not a big fan of this one, but we'll set it to the side and we'll look at the next one. This has loss on both sides, just like the other one. More loss to the downside than the upside. It is 53 and 53. So this is just your straight up calendar instead of a diagonal. Max profit, $43 again. So the same amount of profit as that other trade. One of the weird things about these calendars and the diagonals is they're not fixed the way a vertical is. The max profit and, oddly enough, the max loss can get bigger or smaller. With a vertical, they're set in stone. It doesn't move. But with these, because you're playing the differential of two different prices, volatility can interact a little bit. So I'm going to show you some unrealistic volatility adjustments just to show you how this could expand if volatility was to come in. We won't see this level of volatility, but it works for the visual, right? So let me just give it a little bit of room. Suppose volatility comes in. You see how that thing is growing and our break evens are getting wider and wider and wider? And even the amount of profit that we could make in the trade is getting bigger and bigger and bigger. That's what happens when you've got a calendar on and volatility increases. Your break evens get wider apart, your max profit expands. Unfortunately, so does your max loss, right? Everything just gets bigger. Now, this is an unrealistic level of volatility. That would never happen. But if it did, that's what you could see in volatility. And of course, the other is true too. If we begin to lose volatility, then the trade shrinks. You see how your max loss now is getting much bigger. Your max profit is getting smaller and smaller and smaller. Okay. So volatility adjusts a calendar and diagonals positioning. That's why a lot of traders don't like it. It's not fixed in stone the way a vertical is. I get it. You know what I mean? I get it. But those were unrealistic volatility levels. So with this one, the midpoint's 53. The break even is, let's just set the strikes. 54.21 and $52. So $1 to the downside and $1.20 to the upside. Nice. Got a little bit of a wiggle room there. All it has to do is close inside the tent. And that's not even actually true. We don't need price to close in the tent. We need price to be within this tent a few days from now. Because as time goes by, this trade's going to mature. And we need price to be somewhere within these break even lines so that we can A, manually close the whole trade together all at once, or B, break the trade apart by buying back the short call and keeping the long call. Speaking of that, we talked about how much we could get on the short call, but how much do we have to spend for that long call? It would be a dollar 28 if we split the mid. So 60 cents, dollar 20. We're paying almost 100% more. If we was to net, say, 35 or 40 cents out of that short call, then that would reduce some of our risk in that long call, but not by very much. In a bigger trade like a Nvidia or Amazon or something that's got a lot more premium to it, that could really come in handy. But this is just so small that that short call isn't going to offer you much premiums to help you pay for the long call. And it's very likely we'll just close the entire trade down if everything is working the way it's supposed to. Now, something got turned around here. Oh, that's right. We deliberately did that. I chose that. This damn insurance people just don't stop. I think when we were building these, checking out the different ones, we deliberately picked a 52 and then a 53 and then a 54. So this is the shape you get. Notice all of our risk now is to the downside and the upside has limited risk. We've been building them the other way around on the idea that we really think um, the market's going to stall out here and likely falls down, which would hurt us the least. If we continue to run, it's going to hurt us the most. But if you think that that analysis is wrong, run this one. Flip the whole thing around. In this one, if we continue to run, it's only going to hurt a little bit. But if we really fall hard, that's where it's going to hurt a lot. I'm not a fan of this one because I do think we're going to fade back some, maybe break that low and actually get a lower low if we do break the swings. So, to each your own. I'll stick with this theory, but we'll analyze it just because, you want to be able to build them in either direction. That's what makes these things so nice. And notice we're on the calls on both of these. We could go to the puts and do the exact same trade. We could point it to the upside, we could point it to the downside. We can collect a debit or a credit. It's all on us. And the trade is shaped the way that we want it to be shaped. So this trade as well has a higher debit. So even if we're wrong, this $19 up here is higher than, the 17 here, and just a lot more. And then of course the downside, it's $1.33 if we're wrong and it falls hard. And in the middle, you're still only looking at $40 profit. And then there's the short-term one, which is this one. So I don't know about you guys, but I like this one the most. It suits me. Uh, I am gonna copy it because I want to check something out here real quick. Ah, that trade grid gets me every time. The August 54 short has open interest 14,000. It's only going to give us $22, but I wanted to see what we could get. We need a little more strikes. 55. I knew it right there. Open interest on the oh, it's the wrong one. This one. Not much. Dang. All right. Well, it didn't hurt to look. I guess we could run 54 and 54. Let's do that. All right. So here's the other one. And I just broke it the other way around, right? Since I don't want this one, and this one, we get rid of those. So we've got this one, the one that we've already been talking about. We've done a lot of analysis on it. Hopefully we all understand this one. If not, please ask questions. The goal is to get you to understand this so that you're comfortable putting on the trade and you know what's going on. If I've lost you somewhere along the way, then we got to talk about it so that we can, you know, get you up to speed to where you have a better understanding of the trade. This new one that I added is simply a calendar. It's not a diagonal. 54 strikes on both. It's only 1 week apart instead of these others that went farther out in time from each other. And we have to pay a debit now. We've got a profit of $28, but our risk is $12. That's the maximum you could lose, $12. Of course, the discussion about volatility, it could be a penny or two higher. Remember, this thing can expand like we were talking about. So the risk is much smaller, and so is the profit. It's still 30 instead of 40. And the width of the trade are these break evens. This is a much tighter trade, it's much smaller. There's your break in 55 and 53 for some round numbers. Close inside of that by expiration. And the expiration that we're talking about is the one that's going to expire soonest. Because if you're going to close the whole trade at once, it has to be before August 15th. If you're willing to break the trade apart, then you got to close the front one. You can leave the back one on. So this trade, you pay $12. That's the worst that could happen to you. In this trade, you collect $25. And if the market just rips to the freaking moon, you're on the hook for $75. Again, you don't have to lose that max loss. It won't happen in a single night. It'll outrun us. We'll start to lose the trade. And every day we'd have to decide if we're going to close it or not. And it would get a little more and a little more and a little more negative, never getting worse than 75. This yellow line is what the P&L looks like. So if it outruns us and it continues to run, even if it goes to $55, you would only be down about 46. And if it runs to $56, now you're down, about 60 bucks. See what I mean? Like it's not going to happen all at once. And it would need dollars of movement to get there, which could happen, but we wouldn't just sit and watch, right? We would manage the trade in some way, figure out what we wanted to do and roll it, close it, adjust it. We'd do something with it rather than just sit there and watch it lose. All right. So we need to decide which one of these two trades we want to do. And they're both the same trade at the end of the day. The these are these are both the same expiry trades too. I thought I had one that was going to be a little longer out, but I guess not. Um, this is the most classic of your diagonal calendar trades, and I think I'm going to put that one on. I like this because it's the calendar rather than the diagonal. I think it'll be easier for people to work with. It's the $54 strike. Um, we might adjust that, honestly, but let me get that broker out of the way. $54 might be a bit high. Maybe we'll dial it back a little. 53. See what we get. You see, 54 price is already outside of our tent. 54 says price is going to run up here, and that's our midpoint. And our lower strike is right there, 53.13. We're already at 52.65. So we would need to come back up. This one's in the wrong spot. There we go. 53. Risking $16 instead of $12. That's our max loss, is whatever debit we fill. So we want to work the order and get it as cheap as possible. If you're going to run the one that's a credit, you want to collect as much credit as you can and work the order to try to get 26, 27. But if you're buying it, let's get this for like 15 or $16. And the clock's running. I don't know if we're going to get it if we try to work the order too much. So I'm probably just going to pay the 17, but I'll try for 16. So we've got August 15, 53 strike short, and that's trading for 57 cents. And then we've got August 22nd, which is just 1 week out, trading at 75 cents. Get a picture from my journal. $0.16 on the order. All right, I'm working it. Let me bring it over and show you guys what I got here. Alexa, thank you. So this is, you can see I'm working the order. I don't own the trade yet. My position is a working order. Should say working around here. So, you know what? I own it. Ta-da! I must have failed when I was swapping positions. No, there's working right there. Working order. So I'm trying to fill at 16. It says it's 16, but we got 15 minutes left on the day. I really don't want to bump that up to 17 cents just to get filled. You know, you're giving $1 away just to do that, but I might have to. I want this trade on by the end of the day because, like we discussed, there's traders who want to get into options, but they're a little worried about doing it by themselves. And this is a trade that I said I would get in with you guys. You can follow me in it, even on paper if you want to, and just kind of get a feel for the way options move. Now, I can't stay late today because I've got an appointment. So if you guys have questions on what we've covered today, you really want to start bringing them up so that we can shut down on time and I can leave to my appointment. If not, you can always ask later. All right, we're always around. Throw it in the chat, send me a DM. The more you can understand this trade, the more opportunities you have to trade the market. There's so many things you can do with a diagonal and a calendar. And when you do them on things that you can afford stock on, that changes the game too. So this is simulated trades. You can see how I clicked this and now we're in sim. If we was to add stock here, let's just do one share, just one. You see how it just shifted the whole thing a little bit? And that was just one share of stock. Now we've got 6 shares of stock. You wouldn't think it matters much. Try that with an iron condor one of these days and look what happens to the wings. So there you go, right? Like if we was actually looking at, being willing to purchase 100 shares as needed, right? If we needed to or if we was willing to, it changes a lot. I can't get that right side to go. It's just too small of a stock to do this. I should have used Google or something. But yeah, bringing in stock really adjusts a complex options position, which is what they call anything other than just buying a call or a put. All right, it's not filling, so I'm going to replace the order. And price did go up to 17, so I'm moving my order up to 7. That failed. That's loud. All right, I'm in that trade now. You can see it's on. It's a working order. It's not a working order anymore. I own it. I paid 17 for it. And of course, it's already down $1. That's that $1 that the market was haggling with, right? Where it was bouncing back and forth between 16 and 17. So I paid 17 and it went back to 16. I wouldn't have done that except I wanted this on by the end of the day. So I gave away my dollar. Now, as time goes by, because this is, it has a little bit of life to it, not a lot, but time wise, we've got a few weeks. This is going to give us time to evaluate how it looks on Friday and then next week. And, you guys ask questions about it. You can begin to visualize how these options prices are changing. Remember, I said that my broker does a really good job telling me what I paid for the trade. I don't have to go hunting for it. It's just right there. Man, that's nice. I've got brokers all over the place, and I trade on Fidelity, Schwab, IBKR. I think these guys do the best job of showing me what I have and what I had if I do make a roll. So we'll see how it goes. 17 days until it expires, and we're already down 6% because it lost that $1. Yeah, plus commissions, right? Whatever. It'd be all right. If you guys have questions, feel free to hit me up. This Friday, we still need a topic of choice. If you guys don't have anything, we're probably going to review my broad market tools and see how FOMC and QRA has affected us, right? Because tomorrow's FOMC and tomorrow's QRA. We're going to get QRA at 8:30. Then FOMC release at 2, Powell at 2:30. Tariffs on Friday, but I think as far as I know, I don't have a set time for that. I guess it's just by the end of the day Friday. I'm not quite sure. I'm sure it's just going to be a bunch of headlines anyways, right? But that he's probably going to, well, I don't know. I was going to say he's probably going to kick it down the road and remove the deadline, but I don't honestly know that he's going to do that. So I don't know what he's going to do on Friday. I don't think he knows what he's going to do on Friday, just to be fair. So we will see. You know that chaos was the plan, right? That not disinformation per se, but deliberate chaos was a part of the administration's plan into the April announcement. Yeah. Lighthouser and Scott Bissett had talked to Trump about how the market does not deal well with chaos. Uncertainty is like a red flame for the market. And so the plan was at the beginning of the year, keep everybody off sides. And if the market gets complacent, throw a hand grenade, just like you were talking about. So one of Trump's hand grenades that he likes to chuck out there right now is poking on Powell. It keeps everybody off balance and it keeps the market uncertain because that uncertainty is a part of the whole package plan. It's to help them get the dollar down. It's the 3-3 plan that Scott Bissett put together. So, this is This is all on purpose. Everything that you're seeing in the market, it's not an accident. It's by design, and they're not done yet. So, as long as they want us to continue to go up, we're going to continue to go up. This market function where we've been seeing everybody concerned about all-time highs and yet we just keep going up, that's a deliberate function too. Talk to JP Morgan, BlackRock, Susquehanna, all those guys, and they'll tell you if you can create just enough worry and uncertainty, retail traders will stay short or try to short the market. That's what you need, right? So that you can keep squeezing them and keep grinding higher and higher and higher. And we've seen this before, and that's exactly what we're in. And every time we start to get a little complacent, we think, "Oh, the worst is over. It's good now. Take that brick out of the wall of worry." No, 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 no. They throw another grenade and get the brick of worry back in there, and traders try to short the market again. They get squeezed, and we go a little bit higher again and again and again. That's the plan. Sounds like a tinfoil hat, though, doesn't it? Yep, I do. I got to cut out of here in a bit. Guys, if you do have questions about the trade that we're trying to put on here, you can probably get in it tomorrow. If you miss it today, you can hit me up. I will evaluate it and give you an answer tomorrow if it's still a good trade. The answer is probably yes. If you can fill for less than $20 tomorrow on a buy to open, then it should be okay. Shouldn't be an issue. And I'd say go ahead and do that. If you're uncertain, hit me up in chat, and we'll evaluate it at that time. Otherwise, just remember that this week is supposed to be a sideways week. So far, it has not disappointed. We call that hurry up and wait. And that is very likely going to end tomorrow when we get through with QRA and FOMC. So on Thursday and Friday, we don't know what we're going to get yet, right? If Powell does what he's supposed to and just passes the buck, so to speak, and kicks the can down the road, or use whatever phrase you want, he passes and doesn't raise us or lower us, then we should maintain the boundaries of the weekly expected move as anticipated. If he does anything other than pass, then we're gonna see the market respond. And Jeremy did answer me about posting that into the chat. So Jeremy had that a TNA trade. I'm gonna copy and paste that. It's too late. He does. This isn't his first time running that. Um, it's a bit late today to fill, so you guys will have to focus on it tomorrow. All right. And if you guys got questions on that trade, just hit me up. I'll give you a little deep dive on it. So wait, is this for me, guys? Because I will add it to my itinerary. That's a big fancy word for a Tuesday. Let's see. The fib levels I use. Absolutely. In fact, this reminds me, I did an afternoon stream on these topics. Unfortunately, when we post the links to our afternoon streams as a replay, there's not a nice little write up that goes with it. And I think I'm going to feed a lot of those videos to AI and ask it to give me a nice little summary on those videos that I can post into that channel so that you can just read the summary and see if it has topics, because we've covered some really great topics in there and you wouldn't know unless you just literally go in and watch all of the replays. And I'm not asking you to do that. We're going to go through this topic on Friday, but I'm just saying I want to send those videos to AI and get a nice little summary written on it, because I think that would be great. So yeah, we will go through my fib levels on Friday. My way is unique, but it is easily understood. And by the time I'm done, you should feel comfortable building your own, right? Like I don't mind using the norm that everybody else uses. They use it for a reason, but I like mine better, and I'll explain that on Friday. Cool, cool. Everybody, be careful, be safe. I will see you all in the morning briefing at 7:30.